At the dawn of the 21st century, a titan of American industry reported revenues exceeding $100 billion, yet beneath the gleaming surface of its Houston headquarters, the enterprise was functionally bankrupt. The facade was so perfectly constructed that Wall Street analysts, institutional investors, and financial regulators all bought into the illusion without question. This was a catastrophic failure of corporate governance, a staggering paradox where the seventh largest company in the United States was built almost entirely on phantom wealth. The collapse of this energy behemoth erased over $60 billion in shareholder value almost overnight, leaving a trail of shattered lives and fundamentally altering the global financial landscape. For 6 consecutive years, Fortune magazine crowned Enron the most innovative company in America. Founded in 1985 by Ken Lay through the merger of 2 regional natural gas pipeline companies, the firm initially operated within the predictable, heavily regulated confines of the energy sector. But Lay harbored ambitions far beyond the physical delivery of natural gas. He envisioned a dynamic, deregulated marketplace where energy itself could be traded like a financial security, transforming a traditional utility model into a high-stakes trading floor. To realize this grand pivot, Lay needed an architect capable of building a new kind of financial engine, a mind untethered from the conventional limits of corporate accounting. That architect was Jeff Skilling, a former management consultant who joined the executive ranks with a radical demand. Skilling insisted that the company adopt mark-to-market accounting. Mark-to-market is an accounting method that allows a company to book potential future profits on the very day a deal is signed, regardless of whether a single dollar actually materializes over the lifespan of the contract. If a 20-year energy contract was projected to yield $50 million, the company recorded that entire $50 million as immediate revenue. This practice fundamentally severed the company's financial statements from economic reality, creating a voracious monster that required a constant stream of new, increasingly massive deals just to sustain the illusion of growth. To feed this insatiable demand for new contracts, Skilling engineered a hyper-aggressive internal culture that weaponized human psychology. He implemented a brutal performance evaluation matrix known internally as rank and yank. Rank and yank was a system where employees were graded on a curve, and the bottom 15% of the workforce was systematically fired every single year. This Darwinian crucible eliminated teamwork, bred extreme paranoia, and fundamentally altered the moral compass of the trading floor. Survival depended entirely on booking the next massive deal, regardless of its actual long-term viability or the ethical compromises required to secure it. The psychological toll of this environment cannot be overstated. Colleagues actively sabotaged one another, hoarding information and deliberately structuring convoluted trades solely to inflate their own immediate bonuses. The internal culture facilitated the complex financial fraud not by mandating criminality from the top down, but by creating an ecosystem where honesty was financially penalized and deception was lavishly rewarded. When a culture equates self-preservation with the fabrication of revenue, the line between aggressive business tactics and outright fraud dissolves entirely. As the late 90s progressed, the inevitable reality of the mark-to-market system began to manifest. Many of the grandiose deals booked as massive windfalls ended up losing money. The actual cash flow of the company was abysmal, yet the publicly reported earnings had to continuously rise to satisfy Wall Street and inflate the stock price. The executives faced a mathematical impossibility. They had to hide billions of dollars in toxic assets and mounting debt while simultaneously reporting record-breaking profits. The solution to this paradox required a labyrinth of financial obfuscation. The primary mechanism for this concealment was the deployment of special purpose entities. Special purpose entities, or SPEs, are shell companies created by a parent corporation to isolate financial risk and legally hide debt from its own balance sheet. While SPEs can be used legitimately, Enron executives led by Chief Financial Officer Andrew Fastow weaponized them on an unprecedented scale. They created hundreds of these phantom partnerships, assigning them whimsical names like Chuco, Jedi, and Raptor to serve as financial black holes. Whenever a corporate asset lost value, it was quietly transferred off the main ledger and buried within one of these opaque entities. The sheer audacity of the SPE network was staggering. Fasto himself served as the managing partner for several of these entities, an overt conflict of interest that allowed him to personally siphon tens of millions of dollars from the very company he was supposed to protect. As detailed in subsequent congressional hearings, the board of directors actively voted to suspend their own corporate code of ethics, explicitly permitting Fasto's dual role. This was not a case of a rogue employee bypassing controls. The highest levels of corporate governance explicitly authorized the architecture of their own deception. Such a massive financial illusion could not exist in a vacuum. It required the explicit validation of independent gatekeepers. Arthur Andersen, one of the original Big Five accounting firms, served as both the internal and external auditor for the energy giant. This dual role generated tens of millions of dollars in consulting fees, fundamentally compromising the auditor's independence. Instead of acting as a skeptical watchdog protecting the public interest, Arthur Andersen became a willing participant in the scheme. They consistently signed off on the convoluted SPE structures, providing the necessary veneer of legitimacy that kept the financial markets entirely in the dark. The complicity of the auditors highlights a profound systemic vulnerability in the financial markets of that era. When the entities tasked with verifying truth are financially incentivized to ignore fiction, the entire foundation of market capitalism rots from the inside out. The quiet approvals given behind closed doors allowed the Houston-based executives to project an aura of invincibility. The stock price soared to nearly $90 a share, and the executives were universally lauded as visionary geniuses, even as they frantically patched the leaking hull of a sinking ship. By the summer of 2001, the sheer weight of the hidden debt became impossible to sustain. The company's expansion into broadband and retail electricity had resulted in catastrophic losses, and the dizzying complexity of the Raptor entities began to unravel. Jeff Skilling, citing vague personal reasons, abruptly resigned as chief executive officer in August, just months after officially taking the title from Ken Lay. This sudden departure of the architect sent a quiet ripple of panic through the financial markets, prompting skeptical analysts to finally begin looking closely at the impenetrable financial statements. Inside the corporate headquarters, the walls were closing in. Sharon Watkins, a vice president of corporate development, authored a now infamous anonymous memo directed to Ken Lay. She bluntly warned that the company was about to implode in a wave of accounting scandals, explicitly detailing the toxic nature of the Raptor entities. Lay was presented with a clear, undeniable picture of the fraud. Yet rather than halting the deception and coming clean to investors, he initiated a desperate cover-up. He publicly urged employees to buy more company stock, touting its strong fundamentals, while he and other top executives quietly liquidated millions of dollars of their own shares. The facade finally shattered in October 2001. The company released its third quarter earnings report, announcing a staggering $618 million loss and a $1.2 billion reduction in shareholder equity. The financial markets recoiled in shock. The cryptic explanations offered by management only fueled the panic, prompting the Securities and Exchange Commission to open a formal inquiry. Within weeks, the credit rating agencies downgraded the company's debt to junk status, triggering a death spiral. The intricate web of off-balance sheet partnerships collapsed under the weight of its own leverage. On December 2, 2001, the inevitable occurred. The company filed for Chapter 11 bankruptcy, which at the time was the largest corporate bankruptcy in United States history. The collapse was not merely a financial event, it was a devastating human tragedy. The immediate fallout was brutal and absolute. Over 4,000 employees were terminated in a single day, given 30 minutes to pack their desks and vacate the premises. The vibrant, cutthroat trading floor was reduced to an eerie silence, leaving thousands without severance or health insurance. The most profound cruelty of the collapse was inflicted on the employees' retirement savings. The company had aggressively matched 401k contributions with its own stock, and as the crisis deepened, administrators locked the pension plans, preventing employees from selling their shares. While executives secured their personal fortunes, the rank and file watched helplessly as their retirement accounts plummeted to zero. An estimated $2.1 billion in employee pensions simply vanished. The internal culture that had demanded absolute loyalty and ruthless ambition ultimately devoured the very people who had built the illusion. As the wreckage settled, the regulatory apparatus mobilized. The SEC and the Department of Justice descended, deploying legions of investigators to untangle the fraud. They relied heavily on forensic accounting. Forensic accounting is the rigorous investigation of financial records to uncover discrepancies, fraud, or criminal activity for use in legal proceedings. These specialized teams meticulously trace the flow of capital through the labyrinth of Jedi, Chuko, and Raptor, documenting the precise mechanisms of the deception and the complicity of the executive suite. The investigation triggered a final, desperate act of self-preservation from the enablers. In the frantic weeks leading up to the formal subpoenas, Arthur Andersen engaged in a wholesale destruction of evidence. Employees ran shredders around the clock, destroying tons of audit papers and deleting tens of thousands of emails related to their biggest client. This blatant obstruction of justice was a fatal error. The 89-year-old accounting firm was indicted, convicted, and effectively destroyed, leaving tens of thousands of its own employees jobless and reducing the Big Five accounting firms to the Big Four. The architects of the disaster could not escape the blast radius. Andrew Fastow pleaded guilty to wire and securities fraud, turning state's evidence to testify against his former bosses. Jeff Skilling was convicted of multiple federal felony charges, including insider trading and conspiracy, initially receiving a 24-year prison sentence. Ken Lay was found guilty on all counts, his legacy forever cemented as the overseer of one of history's greatest corporate frauds. However, Lay died of a heart attack before his sentencing, which led to his conviction being vacated under a legal technicality, a final bitter twist for the victims seeking closure. The shockwaves of the implosion fundamentally altered the American legal and financial landscape. The sheer scale of the regulatory failure birthed the Sarbanes-Oxley Act of 2002. This sweeping federal legislation was designed to enforce corporate responsibility, mandate rigorous internal controls, and strictly separate auditing from consulting functions. It required chief executive officers and chief financial officers to personally certify the accuracy of their financial reports, attaching severe criminal penalties to willful ignorance or deliberate deception. The era of blind trust in corporate governance had violently ended. Yet, the true legacy of the disaster lies not in the regulatory ink, but in the psychological blueprint it revealed. The complex financial fraud was merely the mechanism. The internal culture of unchecked ego, normalized deception, and institutionalized fear was the engine. When a corporation values aggressive posturing over ethical boundaries, and when its leadership actively dismantles the very safeguards designed to protect it, the resulting catastrophe is never an accident. It is a mathematical certainty. This investigation examines how the story of this monumental collapse remains the definitive case study in corporate malfeasance. It stands as a stark, enduring warning about the dark convergence of ambition and accounting. The shattered lives, the vanished billions, and the destroyed institutions serve as a permanent reminder that no matter how sophisticated the financial instruments or how visionary the leaders claim to be, an empire built on a foundation of lies will inevitably fall.